8 weeks ago, we watched the largest bailout of billionaire investors we've ever seen. No, this wasn't a government funding package for the banking industry or even a revised tax code to further enrich the top 1% of the 1%. SpaceX went public, and that IPO created an off-ramp for billions of private investment capital that had been sitting illiquid and existing only on paper for years. As of August 20th, nearly 15% of all SpaceX stock became tradable after the second of two of the insider stock lockups expired, meaning those private investors can now start unloading their stock on the public markets and realize anywhere from a 200 to 3,000% profit. Meanwhile, SpaceX continues to lose money, struggle to rein in spending, and navigate new regulatory oversight they've never seen before. But wait, there are two more bailouts coming when Anthropic and OpenAI finally go public. The worst part? These billionaire bailouts are being funded by your retirement accounts, 401ks, IRAs, and investments. How private investors are using public markets to manufacture the largest transfer of wealth from the middle class to the top 1%. Next on this episode of An Acquired Taste. Over the last 5 years, private investment capital flooded into every startup that could spell AI or claim to use the technology as a pillar of their business model. According to Stanford University, more than $420 billion has been invested in these AI startups. So why did that much venture capital concentrate around AI startups? Simple answer: irrational exuberance. Web 3.0 promised the next wave of new technology and innovative startups. Unfortunately for investors, that turned out to be a huge disappointment. Meme coins, NFTs, metaverses, and DAOs were not as revolutionary or as important as promised. Most of these flopped as commercial viability never materialized, and investors were left looking for the next big thing since Web 3.0 turned out to be a proverbial bust. Software as a service, or SaaS, enjoyed a nearly 20-year run of massive private valuations turned successful IPOs turned PE ratios of 10x or more. The eventual Mag 7 was dominated by the SaaS halo, either directly or indirectly, and venture capitalists understood how to invest in SaaS startups. They understood how these companies worked, what it took to be successful, and the eventual profit investments in them would create. The VCs got bigger as their portfolios increased in value. They raised more and more money, and we witnessed the emergence of mega funds like Tiger Global and SoftBank. Things got out of control during COVID when valuation multiples started hitting record levels because investors believed demand for technology that could help people live and work remotely would continue to rise with no end in sight. But the pandemic did end, and the demand for software, especially that software that enabled a virtual human existence, crashed. Meanwhile, Sam Altman, Elon Musk, and a number of Silicon Valley sweethearts launched a nonprofit AI research company now known as OpenAI. Investors were attracted to Musk's involvement and Sam Altman's ability to spin a compelling narrative about what AI would eventually do and what amazing things it could do already. Microsoft, SoftBank, and others stroked huge checks as early investors and continued to invest in the company as recently as this past spring. Many of Anthropic's founding team left OpenAI to start the company, believing they had a better, safer vision for this emerging technology. And then the race was on. Even dumpster fire AI companies like xAI, Humane, and Builder.ai raised billions in investment capital purely out of proximity. As the mega funds and billionaire investors flocked to OpenAI and Anthropic, smaller private investors followed suit and created the greatest concentration of venture capital we may ever see. The move from SaaS to AI seemed to happen in the blink of an eye as billions were poured into unprofitable and unproven companies. But just like the tulip mania of 1637, where a single tulip bulb was worth more than a Dutch single-family home, investors got in deep, really deep, overpaying for access and the opportunity to participate in these overpriced rounds. You know, one of the best ways to support small YouTube channels like mine is to subscribe. If you like the content and you'd like to see more of it, consider subscribing. Back to the episode. Liquidity, or the ability to turn investments into cash or cash equivalents, is easy enough to understand as a concept. If you own a home and hold $70,000 in equity on a $300,000 home loan, you can't trade some of that equity for a gallon of milk at Kroger. You would need someone to buy your house, and the equity you've accrued is then harvested as profit. Then you can buy the gallon of milk. Private investment is similar. $500 million may get you a 3% equity stake in OpenAI, but that's just on paper until some kind of liquidity event happens. Those events usually happen because the company is bought or merges with another company, or it goes public through an IPO or direct listing. SpaceX raised roughly $12 billion in private capital over 24 years. That means SpaceX had investors holding illiquid positions for more than 2 decades. The wait, as it turns out, was really worth it. Founders Fund invested around $600 million over that time period and held about 3% of the company's equity. Their position was ultimately worth more than $50 billion at SpaceX's IPO. And therein lies the rub. When SpaceX went public, it had lost $5 billion the year before. Its biggest launch customer was itself, and xAI had set a burn rate of nearly $1 billion per month before Elon forced SpaceX to buy it, while $12 billion in private investment capital sat patiently waiting for the payoff. Think about it this way. The SpaceX IPO almost immediately made it worth $2 trillion after only generating $18 billion in total revenue and producing a net loss of $5 billion in 2025. That pegs the SpaceX sales to price ratio at nearly 100 times. NVIDIA, with a market cap north of $5 trillion and posted revenue of $130 billion in 2025, has a current price to sales ratio of 25 times. And that's the problem. For companies with enormous private valuations and years of venture money behind them, the public market can become the only pool of capital deep enough to provide exit liquidity at the price early investors need. So when there's no more private money that wants to participate in overpriced financing rounds, and there are no acquisition offers for companies burning cash faster than they can generate more through sales of their own products, there's only one exit strategy left: the public markets. None of this, I should note, is illegal. We can have a healthy debate on if it's ethical or why the system is set up to allow this obviously poor behavior, but it's all perfectly legal. Thus, a bailout for the billionaire investors in SpaceX who had no other option but to pull from the trillions of dollars moving through mostly passive investments in public markets. And that should matter to you, even if you never buy a single share of SpaceX, OpenAI, or Anthropic. Your 401k, IRA, pension fund, and broad market index funds do not invest like a person picking stocks one at a time. They buy whatever becomes large enough to enter the major indexes. Once a company is pushed into the NASDAQ 100 or S&P 500, retirement money follows automatically. Not because millions of individual investors studied the balance sheet and decided the price made sense, but because their funds are designed to track the index. So if a wildly overpriced company enters those indexes and later collapses under the weight of its own costs, early private investors may have already cashed out. The loss doesn't disappear, it just gets spread across ordinary people saving for retirement, public pensions, college funds, anyone whose paycheck is automatically invested every 2 weeks. You may be wondering how this even happens. Why do investors, and more importantly, the funds managing ordinary people's retirement money, buy at these inflated share prices? Remember that whole irrational exuberance I mentioned earlier? The SpaceX IPO is a prime example. There are people, despite the crushing amount of evidence to the contrary, who believe SpaceX is, in fact, worth upward of $2 trillion. Maybe not today, but at some future date, the company will fulfill its promises of colonizing Mars or putting AI data centers in space. There's also general excitement around big IPOs of any kind because there have been so few over the last few years. IPOs can be a quick way to turn profits, especially if you get an allocation at the IPO price and can immediately sell after the inevitable first trade or first hour pop in price. Then there are the systemic reasons they can pull this off. SpaceX used that system to virtually guarantee they could pull off a $1.75 trillion valuation and raise $75 billion in the process. I won't rehash the specific mechanics, but between getting the NASDAQ to lower the number of shares it was required to offer for trade and getting them to fast-track the stock into the NASDAQ 100, that created forced buying from ETFs. Musk and his minions offloaded a meaningful portion of their overpriced, underperforming company shares onto millions of retirement accounts and investors. The scary part? OpenAI and Anthropic are going to run the same playbook. Both have already confidentially filed for their IPOs, and both are rumored to go public at valuations north of $1 trillion. And just like SpaceX, there are no acquisition offers for either OpenAI or Anthropic at these valuations, and private capital seems increasingly nervous as both companies have now arranged alternative funding through debt offerings or other circular financing schemes. They will ask NASDAQ for a limited float and fast tracking to the NASDAQ 100, and guess what? They'll get both because NASDAQ already set that precedent with SpaceX. But here's what's different for OpenAI and Anthropic. Over time, SpaceX has the potential to grow into its valuation as it has multiple lines of business, physical products and services like Launch and Starlink that are competitive in their respective markets. I personally think there's almost no chance that happens without the typical jazz hands chicanery from Musk, but it is possible. That's not necessarily the case with Anthropic and OpenAI, as they're stuck between paying for infrastructure they can't afford but absolutely need to scale. In simplest terms, they have negative unit economics. The product costs more to operate than they can charge to use it. They desperately need capital to fund their scaling, but there's no clear evidence the revenue can catch up to that spend. And if that turns out to be a long-term constraint, both companies will slowly suffocate under the promises inferred by their private valuations, promises their publicly traded share prices can't support. OpenAI and Anthropic have built genuinely impressive technology. Artificial intelligence will reshape whole swaths of the economy. But technological importance does not automatically justify a trillion-dollar valuation. And revenue growth does not erase the cost of building and operating these systems. Both companies carry enormous expectations. Private investors paid prices that require extraordinary future returns. Infrastructure spending keeps climbing, and the business still has to prove it can turn massive usage into durable cash flow. Those expectations become much harder to sustain once the shares trade in public, where quarterly results, operating losses, and real-world competition matter. An IPO changes who bears that risk. Venture funds get a path to return capital to their own investors. Billionaire backers get a chance to turn paper gains into real wealth. Employees get liquidity for stock that may have been locked up for years. And the risk of paying too much moves outward to mutual funds, index funds, pensions, 401ks, IRAs, and the people just trying to make smart, safe investments. Because when private investors need the public market to turn years of paper wealth into cash, the IPO is no longer just a celebration of innovation, it becomes a test of who gets the upside and who gets left holding the bag. That's it for this episode. As always, like, comment, and subscribe. We'll see you next time.